Namaskar everyone, welcome to this video. In this video, we are going to learn how Nifty's price on a daily basis is calculated. As you guys must have seen and wondered that whenever you look at when the market is open any day, so you must have seen the price of Nifty changing every moment. So how this calculation happens? So in this video we are going to learn about that. So before diving deep into it, let us just look at it. So Nifty 50 index methodology. So how Nifty 50 is calculated, what is the process through which Nifty has been calculated so far, what is the structure of index, what is the nature of index, and a brief history about this index Nifty 50 we are going to discuss in this video. So the Nifty 50 is the flagship index on National Stock Exchange of India NSE. It includes 50 of the approximately 1600 companies listed and not listed but permitted to trade on NSE. So what does it mean? This line is clear, I think. The Nifty 50 is the flagship index of National Stock Exchange. It includes 50 companies. So you guys must have seen Nifty 50. So Nifty 50 contains top 50 companies of India out of approximately 1600 companies. So 1600 companies trade on Nifty 50, trades on National Stock Exchange. 1600 companies trade on National Stock Exchange. Now how do they trade? Either they are listed and they trade, or they may not be listed but they are permitted to trade on National Stock Exchange. So this captures, that means Nifty 50 captures approximately 65% of its float adjusted market capitalization. So now what is this float adjusted market capitalization? So if you look at shareholding pattern of any company, let's say Reliance Industries Limited. So if you look at the shareholding pattern of Reliance Industries Limited, you will find two groups, that is promoter and promoter groups and public shareholder. So in the promoter and promoter group, you will find that Reliance Industries promoter and promoter group shareholding would be around 50.46%, and for public shareholding you will find it is around 49.64%. So this 49.64% is your free float number of shares. So the shares held by the promoter is not available for public at large to trade on daily basis. But this rest 49.64% of shares which is held by public at large is available in the market to trade. So this is known as free float number of equities, and if you multiply this free float number of equities with the share price, with the price per share, you will get free float market capitalization. This equals to float adjusted market capitalization. Both are same things. So if you look at Nifty 50 index, so there you will find that 50 stocks are there in Nifty 50. But on National Stock Exchange, 1600 companies are either listed or they just trade on National Stock Exchange. So if you calculate the float adjusted market capitalization of Nifty 50, it is approximately 65% of the total National Stock Exchange's free float market capitalization. So that means what is written over here is that this 50 companies free float market capitalization is equal to 65% of the 1600 companies free float market capitalization which trades on National Stock Exchange. So the third point, the index has been trading since April 1996. The base date for Nifty is November 3rd, 1995. And on this particular date, so what is base date? In this particular date, the constituents of Nifty, what could be the base capital, what could be the base price, was decided on this particular date. And Nifty is rebalanced generally on half yearly basis. So what are the eligibility criteria? Let us now just straight dive deep into this particular PDF that you guys are watching. So I have downloaded this particular PDF from NSE's website, NSE's official website itself. So here it is written Nifty 50 index methodology. So how Nifty 50 is calculated, how it is maintained, how it was constructed, how it is rebalanced, how the price changes each and every moment during the trading hours. It is clearly written down in this particular PDF. So this is the table of contents, introduction, eligibility criteria to become part of Nifty 50, how index was constructed, how index is maintained, how index is governed, index policies, index calculation formula, index variance, index so introduction. So the same information that we saw in our slides is written over here. Highlights also you can see, it is just the same thing. So let us start studying from this point, where you will find the eligibility criteria. So you must have always wondered, you have seen around September 30th, around 30th of September, and you guys must have observed around March 31st, you will see that Nifty is rebalanced, that is, among this top 50 companies that is there on Nifty, you must have seen one or two companies, or maybe more, around 5 companies. It rarely happens, but you will generally see 2 to 3 companies or 1 or 2 companies goes out of Nifty, and you will see that equal number of shares comes into Nifty. So suppose if 2 companies goes out of Nifty, 2 companies will get added to Nifty. So what are the criteria on the basis of what this selection takes place? Now why this is so important for us to learn about this? If you have noticed, if you have observed closely, if a share becomes a part of Nifty 50 index, so you must have heard of ETF, that is exchange traded fund, or index fund you must have heard. So for this kind of things, what happens that the company which is going out of Nifty 50, so the fund managers will sell off those positions into those stocks and will buy these stocks that are going to become a part of Nifty 50. So the fund flows towards these companies from the exiting companies. So this is why we need to look at these companies, and also it is a matter of pride for the company to become a part of Nifty 50, as well as this highlights that there must be something good in this company which is making this particular company eligible to become a part of Nifty 50. Although in past we have seen that companies like Z Entertainment Enterprises, which faced a business failure because of their huge debt taken by the promoters, and companies like Yes Bank, which was also once part of Nifty 50, we have seen corporate governance issues and many other issues. So it doesn't ensure that if a company is a part of Nifty 50, it's always 100% a best company. But still, it has certain qualities to become a part of Nifty 50. So let us now look at what are those qualities. Eligibility criteria to become a part of Nifty 50. Domicile. So the company must be domiciled in India and traded, listed and traded, and not listed but permitted to trade on national stock exchange. So we just discussed this thing. Suppose a company must be domiciled in India, means it should be an Indian company, and traded. So traded means either this company is listed on national stock exchange and it trades, or maybe it is not listed on national stock exchange but it is permitted to trade on national stock exchange. Eligible securities, constituents of Nifty 100 index. So you must have also seen Nifty 50 and Nifty next 50 together, it is Nifty 100, right? So constituents of Nifty 100 index that are available for trading in NSE futures and options segment are eligible for inclusion in Nifty 50 index. So let us now look at this point. So it must be domiciled in India, and next thing is it trades on NSE. That's all. Whether it is listed or not, it doesn't matter. It must be an Indian domiciled company and it must trade on national stock exchange. Next thing is it must be available for F&O trading. Now this thing, differential voting rights. Although this is quite a rare case, but you must have seen shares of Tata Motors DVR. So what does this DVR stands for? This stands for differential voting rights. So also there was another company called Jan Irrigation Systems. So it also has Jan Irrigation DVR. DVR means differential voting rights. So why this kind of differential voting rights shares are issued? So when Tata Motors, they acquired Jaguar and Land Rover, at that time in order to finance that acquisition, they had issued this differential voting rights share. So it's a bit different from the actual shares. So let us now, as we are not discussing about DVR in this particular video, so let us just look at this criteria only, the eligibility criteria to become a part of Nifty 50. Differential voting rights. So you can see equity securities with differential voting rights are also eligible for inclusion in the index subject to fulfillment of criteria given below. So these are the basic criteria for DVR shares. Market capitalization criteria is measured at a company level by aggregating the market capitalization of individual class of security meeting the liquidity criteria of the respective index. Second thing is free float of DVR equity class share should be at least 10% of free float market capitalization of the company. Voting equity class share and DVR equity class share and 100% free float market capitalization of last security in respective index. So what does it mean? This particular point is quite important, that is the free float of DVR equity class shares means, let's say Tata Motors DVR. So free float of this Tata Motors DVR shares should be at least 10% of, means the value of free float of Tata Motors DVR, the value of the free float market capitalization of Tata Motors DVR should be at least 10% of, should be at least 10% of free float market capitalization, should be at least 10% of free float market capitalization of the company. Of the company means Tata Motors, normal shares I am talking about. So that free float market capitalization of Tata Motors DVR should be at least equal to 10% of free float market capitalization of the normal shares of Tata Motors. Voting equity class shares means this, and 100% free float market capitalization of last security in respective index. It should meet liquidity criteria applicable for the respective index. So what is this liquidity criteria? This one is the liquidity criteria. We'll be looking at it again after some time. Upon inclusion of DVRs in index, the index may not have fixed number of securities. For example, if DVR is an existing Nifty 50 constituent is included in Nifty 50, the Nifty 50 index will have 51 securities but continue to have 50 companies. So that means upon inclusion of DVRs in index, so let's say as we have taken Tata Motors DVR in our particular example, so upon inclusion of Tata Motors DVR in Nifty 50, let's say upon inclusion of Tata Motors DVR in Nifty 50 index, the index may not have fixed number of securities. For example, if Tata Motors DVR of an existing Nifty 50 constituent is included in Nifty 50, so let's say Nifty 50 is there, and let's say normal Tata Motors, the normal shares of Tata Motors is a part of Nifty 50. So what it is saying that in spite of the normal shares being a part of Nifty 50, this Tata Motors DVR can also become a part of Nifty 50. But the thing is that in that case, Nifty index will have 51 securities but continue to have 50 companies. So in this case, if Tata Motors DVR also becomes eligible to become a part of Nifty 50, so if you then look at Nifty 50's constituent, it will have 51 securities but will continue to have 50 companies, because these two companies are not actually different. The shares, normal shares of Tata Motors has their voting rights, but for the Tata Motors DVR it has differential voting rights, so it is quite different from normal class of shares. So the number of securities in Nifty 50 will become 51, as it should be generally 50, but it will become then 51, but number of companies in Nifty 50 will remain only 50. I hope this is clear. So the liquidity criteria. So for inclusion in the index, the security should have traded at an average impact cost of 50%. So what is this impact cost now? Suppose, okay, just let us read little more also, or less 0.50% or less during the last 6 months for 90% of the observations for a portfolio of 10 crores. So let's say you want to trade, you want to invest in any share. Let's say this is bid, this is your bidding side, and this is your ask. Means this is your buying side, this is your selling. So this is called as bid ask, but for your convenience I am writing as B and S. B for buy, S for sell. So let's say the buying quantity of, let's say, Tata Motors, this is the ticker Tata Motors, let's say the buying quantity is 100, and let's say the buying price is 450. Let's say the buying quantity is 100 and the buying price is 450, and suppose there is a seller who wants to sell the shares of Tata Motors, 200 shares of Tata Motors at, let's say, 460. So there is a bid ask spread. That means a difference between your buying price at which you intend to buy the shares of Tata Motors and sell price. That means a seller wants to sell his shares at this 460 rupees. So what is the difference between your buying price and selling price is 10 rupees. So this is known as bid ask spread. So there can be people who wants to buy at, let's say, 440, then maybe 435, like that. Any number of quantity, it can be 200, it can be 100, it is 200. So let's say now 465, 470, 200, let's say 100, let's say 200 quantities. So what is the bid ask spread over here? It is 10. What is the bid ask spread over here? It's quite huge, right? It is around 25. So if, let's say now, if you place an order of, let's say 10 crore rupees, so if you just calculate it, you will find it is 100 multiplied by 450. So it is only of 45,000, right? It is of 45,000 rupees worth of shares for the bid side, and for the ask side it is 200 into 460, so it is 92,000, right? So if a buyer comes and wants to buy shares of Tata Motors worth of rupees 10 crore, there is not much liquidity here, right? If he wants to buy, then if he doesn't give any particular buy order at any particular price and tries to buy it from open market without any limit, in that case first transaction that will get executed is at this price, then at this price, then at this price. So the incremental cost will become really high for the buyer. So now let us look at it. So the impact cost is cost of executing a transaction in a security in proportion to its index weight measured by market capitalization at any point in time. This is the percentage markup suffered while buying or selling the desired quantity of security compared to its ideal price. So maybe your ideal price was this, or maybe your ideal price should be this, right? So the buyer wants to buy at 450, seller wants to sell at 460. So what is the in between price? In between price is 450 plus 460 divided by 2. So if you just divide it by 2, then what should be your result? 455. It should be 455, isn't it? So this should be your desired price, but as there is not much of liquidity, you can see, so this buyer, in order to buy shares worth of 10 crore, may have to buy shares at 465, at 470, which is quite huge. If you just calculate it, 460 to 465, if you calculate, the difference is 465 minus 460 divided by 460 into 100. So the impact cost will be 1.08. Here to here, if you calculate it, 465 minus 460 divided by 460 into 100, it is 1.08. 1.08. Now here to here, the impact cost will be 470 minus 465 divided by 465 into 100. So it is around 1.07. So the impact cost is more than 0.5%, right? Which is mentioned over here. So those securities who doesn't have that much liquidity won't be considered, won't be allowed to become a part of Nifty 50 index. Float adjusted market capitalization. So companies will be eligible for inclusion in Nifty 50 index provided the average free float market capitalization is at least 1.5 times the average free float market capitalization of the smallest constituent in the index. So this means float adjusted market capitalization, that means I said free float market capitalization, free float market capitalization. Companies will be eligible for inclusion in Nifty 50 index provided the average free float market capitalization is at least 1.5 times the average free float market capitalization of the smallest constituent in the index. That means, let's say Nifty has 1, 2, 3, 4, 5, 6, 7 and 9, 10, like that 50th number of share. So the 50th number of share, let's say, is the smallest, is the company which has smallest free float market capitalization. And let's say number 1 has the largest free float market capitalization and number 2 has second highest free float market capitalization. So this number 50th company which has the smallest free float market capitalization of, let's say, 20,000 crore rupees, of, let's say, 20,000 crore rupees, right? So what is said here is that the outgoing company, means company will be eligible for inclusion in Nifty 50 index provided the average free float market capitalization is at least 1.5 times the average free float market capitalization of the smallest constituent in the index. So this company is, let's say, the outgoing company, and let's say the incoming company, and let's say the incoming company has a market cap. So let's say this company is going out and the market cap of this company is 20,000 crores and the incoming company. So if you just do this, what would be the result? It would be 30,000 crores. So this should be the market cap of the incoming company. If the market cap of outgoing company is this, the market cap means the average free float market capitalization of the incoming company should be at least 1.5 times of the outgoing company. And this particular is for the IPOs and all listing history. A company which comes out of an IPO is eligible for inclusion in the index if it fulfills the normal eligibility criteria for the index impact cost. Float adjusted market capitalization impact cost, we looked at it, 0.5%, 0.5% that thing, impact cost. This one is your impact cost. Here we discussed in this liquidity section, here this is your impact cost. Then float adjusted market capitalization, this one, and capitalization for a 3 months period instead of 6 months. So these conditions that you just that we just discussed, this free float market capitalization, this liquidity, all these things, these DVRs, this eligibility, eligible securities, and all those stuffs, it should be followed for 6 months. For already listed companies, let's say a company is listed in the stock exchanges for last 1 year, so for the last 6 months these companies have to follow this rule. But for a company who is coming in the market, hitting the market through IPO, so for them these conditions that we just discussed should be followed for the 3 months period only instead of 6 months period. So at the time of index reconstruction, so I just told you guys in our first slide here that index is rebalanced. At the time of index reconstruction, a company which has undergone a scheme of arrangement for corporate events such as spin-off, such as capital restructuring. So for Yes Bank, you must remember how the capital structure was restructured. So at the time of index reconstruction, a company which has undergone a scheme of arrangement for corporate events such as spin-off, then capital restructuring, etc., would be considered eligible for inclusion in the index. So those companies can become eligible to become a part of this index if as of the cutoff date for the sourcing data for preceding 6 months for index reconstruction, a company has completed 3 calendar months of trading period after stock has traded on X basis. So let's say this is the date on which this selection criteria, this information has to be gathered. So here it is said would be considered. So all these companies would be considered eligible for inclusion in the index if, as of the cutoff date, this particular cutoff date, let's say this is 28th of February. Let's say this is 28th of February. On this date, this data has to be gathered. Cutoff date for sourcing data for preceding 6 months. So from here to preceding 6 months, the data is gathered for index reconstruction. A company has completed 3 months of trading period after the stock has traded on X. So let's say the capital restructuring or the spin-off or all those money corporate actions took place before this time. Now let's say February, then you have January full, you have December. So before 30th November, let's say before 30th November, this things has taken place, and from 30th November, so you have 1st of December till 31st of December, then 1st January till 31st of January, and then 1st February till 28th of February. So you have this 3 months, right? So this is the thing it is said here. He has completed 3 months of trading period after. So this share has traded in the share market for, let's say, for the last 3 months on has traded after the stock has traded on X. So after this date, this share has to be traded in the stock market for this 3 months. This is subject to fulfillment of all eligibility criteria for inclusion of index. So in these 3 months, the company has to comply with all these things: float adjusted market capitalization, liquidity, DVR thing, eligibility, eligible securities domicile, all these conditions for these companies which had this kind of corporate action. So for these companies, they will be allowed a 3 months period, and within this 3 months period, they have to comply with these rules in order to become a part of Nifty 50. So this is the simple basic criteria to become a part of Nifty 50 I discussed with you. Now I'll be discussing with you how Nifty's price is calculated every moment. So let us just go on Excel and let us just do a simple calculation, and let us understand how each and every moment while the trading is going on, the price change, the price of Nifty changes. So this is the serial number, this is the ticker, now in this column it is number of equity. So let's say for ticker A, the number of equity shares are, let's say, 5,000. For B, for C, this is number of equities, then share price. So this is the share price. So now, how do you get the market capitalization? Market capitalization means you multiply the number of equity shares with the share price. So you get the market capitalization. See, this is your market capitalization. We just multiplied number of equity shares, which is 5,000, with the share price 45. So this is your market capitalization. And this is the market capitalization for ticker C, for ticker D. Ticker means the short form of company. So let's say for Tata Consultancy Services, the ticker for Tata Consultancy Services is TCS, right? So this is ticker, and the company's name is Tata Consultancy Services. So this is the market capitalization for this companies A, B, C, D till J. We have taken 10 companies, but the constituent of Nifty is 50. But the fundamental thing, the calculation process is same for Nifty 50 as we are doing it here. So now free float percentage. Free float percentage means this is held by public shareholders. Free float percent is public holding. I have written it here. So it means that, as I just earlier explained, for Reliance Industries, almost 50.6%, around 50.6% approx is held by promoter and promoter group. So that is their promoter and promoter group shareholding, and 49.4%, around 49.4% shares are held by public. So this is the free float public holding I was talking about. So let's say for this company, the free float public shareholding was 49%. Let's say 40%. Let's say 25%. Let's say 52%. Let's say 60%. Let's say 35%. Let's say 32%. So now, if you have these two numbers, that is market capitalization and free float number of equities, then just look at it. What we can do here is we can calculate free float market capitalization. Free float market capitalization. So how to calculate free float market capitalization is very easy. You get the market capitalization of any company. If you multiply it with public shareholding, then you get free float market capitalization. Then you get free float market capitalization for all these companies, right? So what is the free float market capitalization for all these companies? So this is the free float market capitalization for all these 10 companies. Free float market capitalization of these 10 companies, you have got it here. So just keep this value. Let us keep this value over here. free float market capitalization on base date. Free float market capitalization on base date was this. So here we told you that the Nifty, the index has been trading since April 1996. The base date for Nifty 50 was 3rd of November 1995 and the base price was 1000 rupees and base capital was 2.06 trillion. So we are assuming that for our index, the base capital, we are assuming for our index, our base capital is this, and for Nifty the base capital was 2.06 trillion and the base price we are assuming for Nifty to be, for our index to be 1000. Same it was for Nifty, 1000. Base price of our index we are assuming to be 1000. So now we can calculate what is weight. How to calculate weight? So we will be calculating how much this free float market capitalization is of the total free float market capitalization of this entire index multiplied by 1000. So this is weight, right? So this is the free float, this is the weight for this ticker A. So what we can do is, simply you just fix this data. Okay, so I have got this data, that is the weight of this particular ticker D. So what is the weight for this particular ticker D in this index is 35.96. So if you just calculate the sum of these weights, you will get 1000. So this 1000 is equal to this base price, right? So now this was the index on day 1 for Nifty, and for our index on day 1 this is the condition. Now I will be, let's say, changing few figures, and this will help you to understand how Nifty reacts on a daily basis. So if you just look at this highlighted portion, if you just focus at this highlighted portion on this Excel sheet, you will find that the free float market capitalization is this now on our starting date. Let's say after 1 year, we are assuming all the price of other tickers remaining constant. Let's say after 1 year, the share price of this ticker, this company A, has become 450 rupees instead of 45 rupees. So now look at when I press enter how this market cap changes, how this free float market cap changes, how this weight changes, and how this free float market capitalization total changes. See, it has changed significantly. The weight earlier was 10.70 now, and the share price earlier was 45, and when it has become 450, see the market cap has changed and the weight has also changed, and the total free float market capitalization has also changed dramatically. Now it was 74 1 year ago. Let's say after 1 year it has become 500 rupees. Now when I press enter, just look at this weight, look at this free float market capitalization of this particular company C and the total free float market capitalization of the index. See how it has changed. So if you just calculate now what could be the price today, you can just calculate it very easily. Live price. So how we can calculate live price is that so this is the live price of Nifty. If now this price share price, price of this share, if it from 450 becomes 1000, how the price of the entire index will change? Just look at it. I'm highlighting it also. So see, if the share price of company A becomes 1000, see the live price has changed. If this 150 rupees changes to, let's say, 250, how, look at it, how the live price changes. See, the live price has changed. This share company G, if from 985 rupees of share, if it becomes 500, so how the live price changes? Look at it. This company, look at it, from 350, if it becomes 750, how the live price changes? Look at it. So like that, this is how Nifty works. Now for this company, let's say now this company C has a share price of 50 rupees only, and the live price is only 1210.64, and the weight you can see is so little. It is only weight of 6.51 out of this 1000, right? So if this share price gets doubled, how much impact on price it will make? If I just make it 100, see, it is 1210.64. See, 1210.64. So how much it has changed? 1210, only 1218. So only 8 rupees change because it has very small weight. Now if the share price becomes 500, it has some significant weight of 61. Now if the share price becomes 5000, then it has huge weight. Only a little bit change, only 10% change in the weight. See, this is consisting of now almost 40% of the index, company C. Company C has become 40% of the index, right? 40% of 1000 is 400. So if just 10% of this index changes, if the 10% price of this particular share changes and it becomes 4500, see the impact, how this will change. So it has 40% weightage. This share has 40% weightage now on index. So if the price changes 10%, if the share price of this share if the share price of this particular share changes by 10%, how much do you think the price will change? Will the index price will change by 10%? No. It will change by 4/10 of 10%. See how much is changed. So this is how our index works. This is how your live index works. If it becomes 255, a little bit of change. If it becomes 445, little bit of change. So it depends on this weight, and this weight depends on this free float market capitalization, because we calculated this from market cap, free float market capitalization upon the total free float market capitalization. So company's free float market capitalization upon total free float market capitalization of the entire index multiplied by the base price is your weight for the particular index. So how much weightage you have on the index, it depends on your free float market capitalization, not even on your market capitalization. See, this company has market capitalization of this much. Let us find a company which has quite significant. Just look at it. What I was just trying to say, it's given over here. See, the market cap of this share is more than market cap of this. The market cap of share I is much more than market cap of share A. But see, what makes the difference is the free float number of equities. Free float public holding for company A it is 50, almost 14, it is 49%, and for company I the free float number of equities when a free float public holding is 25%. So it has lesser weightage on index, and it has more weightage. Company A has more weightage in the index, and this is the reason. Now, if you just go back and find the real data in Nifty, the largest weightage in Nifty, Reliance Industries has the largest weightage in Nifty currently. After that, probably currently this is HDFC Bank's weightage. So this is how it works. This is why if just Reliance Industries goes up little bit or down little bit, the entire market sentiment changes. So this is the importance of this index components, and this is how index is calculated on real-time basis. A little bit of change in price, it impacts on the live price of that particular index. So this is how index works. This is how it happens. Well, so that was all in this session. We have discussed how this Nifty index works. So I hope that you found this video useful.